It's a road our government has traveled too many times, and it is happening again. The consequences of passing record stimulus packages in today's fastest 4 minutes in finance. Well, hello again. I'm Scott Inman. If you've ever maxed out your credit card, you've probably at least entertained the idea of asking the credit card company to raise your credit limit. Now, nothing good can come from that, and if it's in your personal economy, you can always decide to stop borrowing and just deal with the debt. Unfortunately, the U.S. Congress doesn't operate that way. Our lawmakers have run up debt that surpasses their credit limit, and now they face, yet again, the decision of whether to raise that limit to pay for the money they've already spent. Yes, there is another debate on the horizon of whether to raise the debt ceiling. According to a government website, Washington has approved outlays of $2.8 trillion and has obligations of $3.2 trillion in response to the COVID-19 pandemic. And that's on top of the overspending they are already engaged in on a regular basis. As one commentator has said, quote, "An ideal like the debt ceiling could only be cooked up in Washington. Instead of restraining Congress from spending taxpayer money, it invites them to run up debt first and then debate later whether to pay for it or not." But that's where we are. The stimulus packages will be paid for by selling treasury bonds, and that's selling debt. If they need to sell more than the debt ceiling allows, they have to raise the debt ceiling. If they don't, it could signal to America's creditors that it can't be trusted to pay back its debts. And that could cause a lowering of the U.S. government's credit rating. And it's happened before. You may remember in 2011, Washington debated whether or not to raise the ceiling for long enough that it looked like we would surpass the deadline to do so. Standard & Poor's, that's the S&P, as in the S&P 500, downgraded the U.S. government's credit rating, and that caused a panic in the stock market. So it stands to reason it would again. Treasury Secretary Janet Yellen said last week about failing to raise the debt ceiling that, quote, "I believe it would precipitate a financial crisis. It would threaten the jobs and savings of Americans at a time when we're still recovering from the COVID pandemic," unquote. So it's unclear when the government would reach that debt ceiling again, but it could happen as early as August. It is a major headwind to the economy and the markets. But it's easily avoided if Congress can work together, and we all know how rare that is. The bigger issue is there's no end in sight for the rising debt. Remember when we said Standard & Poor's lowered the U.S. credit rating in 2011? Before they did that, in August of that year, they wrote the prescription to avoid it in July. To avoid a downgrade, the S&P said the United States needed to not only raise the debt ceiling, but also develop a credible plan to tackle the nation's long-term debt. 10 years later, we are still waiting for that. Thanks for watching. Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.